Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Tuesday, May 19th, and we're seeing some notable market shifts as tech leads stocks lower amid ongoing geopolitical tensions. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. Well, the dominant narrative today is definitely the geopolitical pressure weighing on markets, particularly tech stocks. We're seeing President Trump's comments about Iran creating uncertainty, with him stating the clock is ticking after holding off attacks following Gulf appeals. This is having a ripple effect across risk assets. But what's really interesting is the divergence we're seeing in different sectors. Home Depot just reported earnings that beat estimates with 5% sales growth, and management specifically noted that their core shopper remains resilient despite higher gas prices. They're calling small DIY projects a real source of strength, which tells us that consumer spending at the middle to upper income levels is still holding up reasonably well. Meanwhile, we're seeing this massive transformation happening with AI that's reshaping not just markets, but entire workforces. Standard Chartered just announced they're cutting back office workers by 15%, explicitly stating they're replacing what they call lower value human capital with AI. That's a pretty stark statement about where we're headed.
That's a significant shift in how companies are thinking about their workforce. What does this mean for traders and investors trying to position themselves?
The key here is selectivity. We're in an environment where broad market rallies are on pause. As the Wall Street Journal put it this morning, investors are staying cautious, and that means you need to be tactical about where you're putting capital. The big story that's not getting enough attention is the retreat from US Treasuries by foreign governments. Japan and China are leading this exodus, and it's directly tied to Gulf War fallout and currency concerns. That's putting upward pressure on yields, which creates headwinds for growth stocks. On the opportunity side, we're seeing some interesting developments in commodities. Aluminum is setting up for what analysts are calling the most bullish configuration in over 50 years, with targets of $4,000 a tonne. In the energy space, NextEra Energy just announced a $67 billion Dominion acquisition that positions them as the dominant power player for the AI era. That's the kind of infrastructure play that makes sense when you're thinking about the massive energy demands AI is going to create. The trading implication here is that you want to be in companies that are either leading the AI transformation or providing the essential infrastructure for it, while being cautious about companies that could see margin compression from workforce disruption or geopolitical uncertainty.
Let's talk about the indices themselves. How are you reading the technical picture across the major benchmarks?
Looking at the S&P 100, we're seeing consolidation after the recent rally, with support holding around the 3,240 level. The index is trading in a relatively tight range, and what I'm watching is whether we can hold above that support with the geopolitical noise. If we break below, the next meaningful support comes in around 3,100. On the upside, resistance is at 3,320, and we'd need to see a clear catalyst to break through that level. The Nasdaq is showing more weakness, which makes sense given it's more heavily weighted toward tech stocks that are taking the brunt of the Iran tension sell-off. We're testing the 18,500 support level, and there's some real risk here. The Nasdaq has been the leader, so if this breaks down, it could signal a broader market correction. I'd want to see a decisive move back above 19,000 before getting more constructive. The Dow is actually showing relative strength, which is typical in a risk-off environment. It's holding above 41,200, and the more defensive nature of Dow components is providing some stability. The divergence between the Nasdaq and the Dow is telling you that investors are rotating toward quality and defensiveness rather than growth and speculation right now.
That defensive rotation is definitely something to watch. Steve, let's get into the economic picture. What data points should we be focused on this week?
Thanks, Robert. We're in a relatively light week for major economic releases, but what we did get recently is quite telling about the state of the economy. The retail sales data that came out last week showed continued resilience in consumer spending, which aligns with what we're hearing from Home Depot about their core customer remaining solid. However, we need to be careful about reading too much into that because we're also seeing signals that higher energy prices are starting to bite. Gasoline prices have been climbing, and while Home Depot says their customers are resilient in the face of that, we know from historical patterns that sustained higher gas prices eventually show up in discretionary spending pullbacks. This week, we're watching for the FOMC minutes from the last meeting, which will be released on Wednesday. That's going to give us insight into how the Federal Reserve is thinking about the current inflation picture, especially with oil prices elevated due to the Iran situation. The Fed has been in a holding pattern, but if we see language suggesting they're concerned about inflation re-accelerating, that could shift rate cut expectations further out. We're also getting preliminary PMI data for May on Thursday, which will give us a read on both manufacturing and services sector activity. The manufacturing side has been weak, but services have held up reasonably well. Any deterioration in services would be concerning because that's where the bulk of employment is. Looking ahead to next week, we've got some heavier data coming with durable goods orders and the second revision to first quarter GDP. So traders should be positioning for potential volatility around those releases.
Those FOMC minutes could definitely move markets if there's any shift in tone. Lizzie, let's shift to crypto. What are you seeing in the digital asset space?
The crypto market is under significant pressure right now, and Bitcoin specifically is dealing with multiple headwinds. BTC has lost its hold on the $80,000 level and is currently struggling around 76 to 77,000. Having given up all of May's gains, the sentiment has turned decidedly bearish in the near term. We're seeing retail demand that has plummeted 73%, with futures selling exceeding $2 billion. That's a massive shift in positioning. ETF flows are telling a similar story, with outflows hitting nearly $1 billion and $648 million in losses just recently. However, there's an interesting divergence happening beneath the surface. While retail is capitulating, we're seeing selective institutional buying MicroStrategy. Following Michael Saylor's playbook, just scooped up another $2 billion worth of Bitcoin, bringing their total holdings to 843,738 BTC. SpaceX is sitting on a $637 million Bitcoin stack ahead of their potential IPO. So you have this dynamic where weak hands are selling and strong hands are accumulating. The technical picture suggests we're likely testing the $74,000 support level next week, and if that breaks, we could see a move down to the 70 to 72,000 range. There are also some longer-term concerns emerging, with Citi warning that Bitcoin faces an outsized quantum threat as computing breakthroughs accelerate. That's more of a tail risk, but it's something the market is starting to price in.
What about Ethereum and Solana? Are they following Bitcoin's lead?
Ethereum is actually looking worse than Bitcoin right now, which is notable. ETH dropped to the $2,000 level, and traders are saying bears are in control. What's particularly concerning for Ethereum is the internal turmoil at the Ethereum Foundation. We've seen a wave of high-profile departures, with 2 more researchers leaving just recently. That's creating uncertainty about the protocol's development roadmap and governance. However, similar to Bitcoin, there is some institutional buying at these lower levels. Bitmine just purchased 71,672 ETH worth over $143 million with their CIO Tom Lee, calling the pullback an attractive opportunity and tying it to rising oil prices and macro factors. For next week, I'd expect Ethereum to test that 1,900 to 2,000 support zone, and if selling pressure continues, we could see further downside to 1,800. The foundation instability is a real concern that could continue to erode confidence. Now, Solana is the interesting outlier here, showing relative strength while Bitcoin and Ethereum struggle. Sol is actually attracting institutional inflows, and we're seeing major banks deploying billions into the Solana ecosystem. The narrative around Solana is shifting from a meme-coin casino to a serious institutional blockchain. Real-world assets on Solana just exceeded $2 billion in market cap, and the chain GDP hit $342 million. XRP and Solana funds are seeing inflows, while Bitcoin is experiencing outflows, which tells you there's a rotation happening within crypto toward assets with strong fundamental adoption. For next week, I'd expect Solana to outperform with potential to reach the 180 to 200 range if the broader market stabilizes. The key factors to watch are whether Bitcoin can hold that 74K support, whether Ethereum can stabilize around 2,000, and whether Solana can continue attracting institutional capital despite broader market weakness.
Well, that's certainly a lot to digest across traditional markets and crypto. Thanks to both Lizzie and Steve for breaking down these complex dynamics. For our listeners, the key takeaways are the defensive rotation happening in equities, the light economic calendar this week with FOMC minutes as the main event, and the significant pressure in crypto markets with notable institutional divergence. Remember, do your own research and consult with financial advisors before making investment decisions. If you found today's discussion valuable, please subscribe to the Morning Bell so you never miss our daily market analysis. We'll be back tomorrow with more insights to help you navigate these markets. Until then, trade carefully out there.